Hello, good morning to all. Welcome to today's Daily Dose of Market Insight. I'm Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Thursday, 8th of February 2024. So before we start our Daily Dose of Market Insights, let's take a look at the usual disclaimer. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, and oops, sorry. Okay, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so let us have a recap of what happened overnight in the US session yesterday. So the markets actually continue their risk-on behavior. So for those who actually joined our daily dose of market insight in the past few sessions, we still do actually share with I do still share with you guys that there are a couple of intermarket relationship we got to monitor. The US 10-year Treasury yield, it has an impact on the US dollar, and as well as this ongoing major risk event that is taking shape right now in the US regional banking space, which is that real estate commercial risk in the books of one of the New York regional bank that is causing a bit of jittery in terms of negative feedback looking at the market. But however, due to positive elements that is being seen on the US 10-year Treasury yield inching downwards below the 200-day moving average, spilling over to dollar weakness that was seen overnight yesterday, and it causes this a broad-based rally that's being seen in the US benchmark stock indices. So if you look at the S&P 500 heat map yesterday, like I share with you all in my usual daily dose of market, frequent daily dose of market insights. So it gives insights to us what's going on underneath the carpet of the S&P 500 company. So previously, right, we tend to see the one that is being filtered around the mega cap stocks, all right, in the last few sessions. And right now, yesterday is being spreading across throughout the entire S&P 500 universe. All right, so overall there is more green than red, what we could see visually, and most importantly, the banks itself has started to recover as well, despite the fact that over here we have this news flow of NYCB. So this is the New York Community Bank core bank that is causing this what I call we call it kind of jittery movement in the US banking regional space that is spreading over, that is spreading this FUD what in the US banking sector on this what I call ongoing real estate commercial risk that is inherent in the bank's balance sheet. So what you could see over here is that they're actually in talks to offload mortgage risk, exploring loan sales. But overall, this particular news flow is deemed as positive. Why? Because how do we know that? We look at how the sentiment, okay, news flow is news flow, but how does sentiment react to news flow is more important. So sentiment reacting to news flow can be inferred by a liquid, what you call it, a heavily traded, exchange traded fund that is being centered in directly linked to the US banking sector. As we all know that the US banking sector is actually taking the hit of this NYCB real estate mortgage risk in their balance sheet. So if you look at it, this is what I shared with you all yesterday. One of the ETF that we could look at is called the SPDR S&P Bank ETF KBE. So this KBE ETF consists of both major banks and as well as regional bank, which the NYCB is part of it. So what you could see over here is that this is the weekly chart. Yesterday I shared with you all, this is the key support zone that we are looking out for, 4270, 4070. Over here, this zone over here, why is it important? Because it confluences with this former descending trend line that was broken out last year, turns into a pullback support, and the former major medium-term swing high turns into a pullback support as well. So we could see over here that this is the weekly candle. Selling pressure has started to ease off by this long-legged candlestick. And if you zoom into the daily chart, for those who knows technical analysis in terms of Japanese candlestick, it starts to flash out a bullish dragonfly doji reversal. Okay, initially there was a huge sell-off at the start of the US session, but towards the later part of the US session, there are actually bidders coming in to build up the ETF prices. So overall, despite that this ongoing we call it a very negative media portray on this NYCB, but sentiment has started to actually turn rather positive in terms of the KBE ETF price action as inferred by the technical analysis that I share with you over here. So that actually also causes, number one, why the major US stock indices all closed in the green yesterday. So the SPX is up 0.8%, the Nasdaq 1.04%, the Dow Jones up 0.4%, and the Russell slightly down negative 0.17%. Pardon me, it's not all close to the green, except for the Russell 2000, which is still down negative 0.117%, but still not too bad. It's not down negative 1%. But most importantly, what is causing this ongoing risk-on behavior in the major US indices, like I shared with you all, is due to the fact that the US 10-year Treasury yield is actually is actually inching downwards. All right. So why US 10-year Treasury rate is important? Okay, let me flash to you the chart of the US 10-year Treasury yield over here. Okay, so the US 10-year Treasury yield, take it into account that is actually a long-term benchmark borrowing cost or funding rate. If the US 10-year Treasury is going to inch downwards, didn't break above the previous swing high area of 4.2% and continue to hover below the 200-day moving average, it's indicated to us that further upside may be kept, which is so positive for this long duration liability that's being sit under the commercial banks as well as the regional banks books itself based on the discounting factor. All right, that yesterday, the US 10-year Treasury continued to maintain below the 200-day moving average. And what's interesting over here is that the daily RSI has started to shape a lower high, indicating to us there's some signs of medium-term downside momentum creeping back into that US 10-year Treasury yield. So with the US 10-year Treasury yield being kept below 4.2% and below the 200-day moving average, it also translates to dollar strength that is being kept as well. So if you look at the dollar strength index yesterday over here, there is actually this dollar strength index is being, okay, one second now, it seems to me that, yeah, okay, still recall we do have a resistance level to watch. Okay, what happened is going on over here? Give me a minute, sorry about that. Okay, I think there's something wrong with my screen. It's frozen at this moment in time. Okay, one second. My apologies. Okay, let me get it. Okay, so now it's better. Okay, so over here, still recall that dollar index, we do have a resistance at 104.30, 104.80 over here. So price action hit this level and it did shape that bearish candlestick and it starts to trade down lower in the last two sessions. And in fact, right now in Asia session, it's attempting to trade inch down lower as well. So over here, it seems to us that the dollar strength has been resisted at this 104.30/104.85 resistance zone, as depicted by the US dollar index. So that is also being we call it a kind of related to that US 10-year Treasury yield refusing to break above the 4.2% level and the 200-day moving average. So all in all, dollar weakness, US 10-year Treasury yield strength being muted, it will actually lead to this risk-on behavior that is still ongoing in the major US stock indices that is trying to spread throughout the rest of the world, perhaps less muted in the China and the Hong Kong stock market. Why? Because the China and Hong Kong stock market is now being what I call more or less related to internal structural problem, which is the deflationary risk scenario, and as well as a climate that is not international investor friendly due to the individual policy that's been enacted by the China top policymaker, and as well as going forward there could be a high risk of US China tension that going to inch up much further in the later part of this year due to this ongoing US presidential candidate debate that is going to get more heated up after H2, and especially we know that if Trump being the top candidate, it seems to be that is right now for the Republican camp, where Trump in the last few days he tends to be in favor of imposing trade war 2.0 towards China by floating out the idea of taxing China imports to US by 60% tariffs or more. All right, so that's actually causing this very weak China Hong Kong stock market performance against the rest of the world. All right, so this is one data to take a look at. And also, like I mentioned earlier, China do have this inherent deflationary risk scenario that is still being played out over here. So if you look at today's data that is came out just a while ago, 9:30 a.m. Singapore time, China inflation rate. All right, so let me share with you my screen just to make sure that my screen is showing. Yes, it's showing. All right, so China inflation rate. Okay, let me over here, let me put it much wider so that you guys could see. Okay, so China inflation for the month of January, it came in worse than expected. Markets expecting negative 0.5% year on year. It came in negative 0.8% year on year. So if you look at it over here, right, the deflationary risk spiral is still inherent in the China economy. So right now it's doing what I call 1, 2, 3, 4 consecutive months of negative year on year growth in terms of inflation rate. So you look at the 5-year trend, it's clearly deceleration on the downside and it's below negative. And currently there's no signs of turning up. And if you look at the PPI data, which is factory gate data, so factory gate data is something like a leading inflationary data in terms of inflation. So this is where businesses charge their input prices. So if businesses going to have a lower input prices, it will actually fit into lower consumer prices as well. So the PPI year-on-year data came in almost expected, negative 2.6% year-on-year. Came in slightly better only, excuse me, at negative 2.5% year-on-year. So if you look at the trend of the PPI, I will call it the factory gate prices or producer price index in full. So if you look at the PPI over here, okay, it's inching downwards as well, the 5-year trend. All right, but it attempts to still be slowing down. Okay, but it's still sideways unless it got to actually inch up higher compared to the previous month. That means the trend to break out over here, it got to actually continue to inch much higher the next month or so. That means below negative 2.5. That means heading around negative 2 or negative 1. Then we will still see signs of stabilization in terms of the PPI data. So at this point in time, it seems to us that it's still relatively there's still a deflationary risk spiral that is still ongoing in China at this point in time. All right, so this is the key data I'd like to share with you all. And also before we jump straight into the short-term technical outlook, there is a various sign of what I call Fed speak over here. So Federal Reserve officials spoke yesterday. There are actually 3 of them, Collins, Kashagri, and Barkin, as well as 4 of them, Gutler. Okay, so all of them kind of net they actually signal the readiness to cut too soon. That means we're talking about forget about that highly anticipated March cut, which is next month. So if you look at the CME Fed Watch 2 for March, only 80% chance. So that is actually more or less we're talking about March expectation is being killed off, and right now we are actually focusing more on potentially to come in 1st May instead. So 1st May, a total of because 53% chance to cut of a 25 basis point, 10% chance saying 50 basis point cut to 47.50. So you add this 53.10 together. So overall, there's a 63% chance of a rate cut coming in May, 1st May FOMC meeting as being inferred by the CME Fed Watch 2, taking into data of the 30-day Fed funds future. So overall, right, what we could see over here is that the easing mode in the US is still intact. It's only that when will they start cutting, and the next key step is the magnitude of the cut. All right, so to see the magnitude of cut as being priced in by the 30-day Fed Fund futures, we could actually go on to this one called probability. All right, so in probability over here, let me share with you. If you look at the one that is in light green, so you start to count down all the way to end of 2024 over here. So what we have over here is you have 1, 2, 3, 4, and 5 cuts. So initially, before January FOMC and before last Friday rosy non-farm payroll data, market is pricing in 6 interest rate cut before 24 ends, Fed funds rate cut. So right now the market is also pricing in 5 interest rate cut, given the less dovish guidance that was given on FOMC, and after that strong US job number data indicate to us that the US economy is still in a Goldilocks scenario that is very hard for the Fed to actually start to be more aggressive in their interest rate cut cycle. All right, so overall, but it's still easy mode. It's still an easing mode, right? So that's why it actually represents to us the US 10-year Treasury yield is still inching downwards slowly, but not rapidly, and that actually give us a still weaker US dollar price action as seen yesterday, which translate to this risk-on behavior in the US market as well as globally. But China and Hong Kong stock market to a lesser extent. Why? Because of that deflationary risk scenario that is still inherent in China. All right, so that's I'll try to actually join the dots for you guys to see the interlinkage across the market based on technical in line with fundamental as well. Okay, good. So now, one more news flow before you go is this very important for Bank of Japan. Why? Because it will instill confidence in the Japanese economy. So right now over here, right, there is actually based on the last data that BOJ collate in December. As you know, that Bank of Japan still has this 0.1 interest rate on certain accounts where lender park access funds 8 years ago. But based on the latest data in that they have on December, latest data for December, okay, there is a big spike where banks hold their reserve in Bank of Japan negative interest rate account, negative 3.2%. So what it means that over here, the confidence of the commercial bank in Japan is giving us a clear signs, right, that sub-zero account that they park their access fund with Bank of Japan, that means they park their 0.1 account. That means they are earning no interest. Instead, they got to pay to Bank of Japan. But why they park so much amount of 3.2 trillion over here? It tells us a signal that the commercial banks, the big banks are not the small bank, the Japan big banks, commercial banks, has give a bit of signals indicating that they have a strong view that sub-zero rates are almost about to end soon in Japan. Okay, this is a signal that's being inferred by their action. So if sub-zero interest rate were to end in Japan, that means potentially, right, it could actually install more confidence in the Japanese economy that they are no longer in deflationary mode anymore, or the risk of slipping back into deflationary mode is very slim, and they could instill consumer confidence to start spending, because interest rate going to get higher or get normalized soon, and as well as corporate investment got to get higher as well. Why? Because if the corporate investment don't start spending now, and if they borrow much later from the banks over here, they're going to be charged at a higher interest rates. All right, so it's no longer telling the Japanese economy that interest rate will remain negative forever. There will be cheap access of fund where corporates will delay their capital deployment because of this forever low interest rate environment in Japan. So Japan low interest rate environment got to get normalized in line with what is going on in the global economy right now. So net overall, it's positive for the Japanese economy, but it's positive for the Nikkei 225 as well. So that's why you see the Nikkei 225 is actually continue to show strength on strength month on month, despite that if you see some media fields saying that if Japan got to exit out from negative interest rate, the Nikkei 225 got to collapse. But unfortunately, the answer is no. Instead, the Nikkei 225 potentially could continue its major bullish trend that has kickstarted 2 to 3 years ago, and it starts to accelerate in the last 1 year. And in fact, Nikkei 225 today broke out a key resistance level. For those who actually keep on hearing to my daily dose, you know what are the key resistance levels. So later, immediately I will flash right now on the short-term technical outlook. All right. So now straight away, now let's jump to the short-term technical outlook on the Nikkei 225, which is the one of the major stock indices over here. Okay, so let me expand my screen so that you guys could see. All right, so Nikkei 225. So Nikkei 225, previously we are trapped in a range below 36,540, and yesterday we do have a bearish bias, still inching downwards, but not below 35.75, which is the bottom of the range support that is in place since 26th of January. So yesterday during the late US session, it almost hit that level. So early US session, it printed a low of 35.833, give or take is about 35.745. Before shaping a similar low, and right now and started to trade higher throughout the close of the US trade higher throughout the US session yesterday, and right today Asia session, it managed to do a bullish breakout above the range resistance that we've been watching since 24th of January at 36,540. So that's about 2.5 weeks ago. So a clear bullish breakout of this level indicate to us that short-term momentum has started to creep back into the Japan 225 or the Nikkei 225. So with that, we'll flip to a bullish bias right now. No longer bearish bias because it's clearly broken above the range resistance. So the odds of coming back to retest the range support back again, it seems slim at this juncture based on the technical elements that we are seeing right now. So with that, right, we could afford to have a tightened key short-term pivotal support right now in any potential pullback towards 36,180 short-term pivotal support. So I'll be using 36,180, not the 7, a bit of tongue twisting, 36,180 as my short-term pivotal support level to hold any potential pullback. We also confluence with the upward sloping 20-day moving average as well. As long as 36,180 holds, maintain this bullish bias on the Nikkei 225 or the Japan 225. Next resistance to watch, psychological level 37,000, which is the minor swing high area of 23rd of January, and as well as the FIBO extension level of 37,480. What's 37,480? Is a confluence with the major ascending channel upper limit as being seen on the daily chart, which I draw from the low of January 2023 over here. All right, so flipping back to the hourly chart. So as long as 36,180 short-term pivotal support holds, maintain that bullish bias on the Japan 225. Only an hourly close below 36,180 negate this bullish tone to see a retest again on the a minor range support at 35,745. All right. Very quickly, Hong Kong 33 or the Hang Seng Index. So Hang Seng Index, if you recall, yesterday we do have a bearish bias. It really hit this short-term support level at 15,880, hit the support level already. So with that, right, it's coming down very close to the 20-day moving average. So we'll be flipping to a bullish bias back again on the Hong Kong 33, given that it already hit the support level for today. But I don't want to use 15,880 as my short-term pivotal support because it's too tight. I will use 15,640, slightly below the 20-day moving average, pardon me, not 200-day, 20-day moving average, also the minor swing high area of 5th of Jan, and also coming very close to this minor ascending trendline support that I draw from 22nd of January 2024 swing low. So right now, 15,640 short-term pivotal support, as long as not surpassed the downside, potentially there could be a rebound taking shape coming into play, and given the fact that the RSI seems to be coming to a support level as well. All right, bouncing off from the ascending support. So with that, right, 15,640 short-term pivotal support level, resistance level to watch in first step over here will be yesterday's this minor spike up. All right, yesterday's intraday high at 16,250. We also correspond with the 50-day moving average as well. All right, so first resistance to what? 16,250, then thereafter followed by the next resistance at 16,525. However, an hourly close below 15,640 will invalidate this short-term counter trend rebound scenario to see the continuation of this bearish momentum to retest the fifth, the 2nd of February minor swing low area that correspond with the 23rd of January minor swing low area, acting as a next support at 15,300 level. All right. German 30, so no change. German 30 yesterday managed, it actually traded down, but still managed to hold above the 16,870 short-term pivotal support level. So no change, still maintain that bullish bias on the German 30 as long as 16,870 short-term pivotal support holds. First resistance to watch will be at 17,130/17,155. Only an hourly close below 16,870 negates this potential bullish tone to see a further slide to retest 16,795 area slash 16,700 area over here, which is correspond to the rising 50-day moving average as well. Now, US major stock indices. Let us start with the Wall Street 30. So very nicely, Wall Street 30 continues to trade in a bullish tone within this minor ascending trend line that I draw from the low of 18th of Jan over here, going to shape higher high and higher low. So I'll be using yesterday's minor European session minor swing low, which correspond to the lower limit of this minor ascending channel, and as well as this minor congestion zone over here. 6 Jan resistance broke, turns into a pullback support over here. 6 Feb, minor resistance broke, turn to pullback support. Okay, so I'll be using a slightly tightened key short-term pivotal support today for the US Wall Street 30. 38,450 short-term pivotal support. Any pullback that managed to hold above 38,450, maintain that bullish bias. For sure, first resistance 38,750 that was tested yesterday before trading sideways during the Asia session today. A breakout above 38,750 sees the next resistance coming in, which is the Fibo extension level at 38,950/38,970. Only an hourly close below 38,450 negate this bullish tone to see another round of minor corrective decline to retest the 20-day moving average. Now also conferencing with a graphical support zone at 38,200/38,080. Nasdaq 100. Okay, so Nasdaq 100 very bullish. Hit the first resistance 17,750 yesterday. No, 17,750. Pardon me, yesterday before trading sideways during the Asia session. So with that, I'll be using a tightened key short-term pivotal support for today at 17,500 level. So what's 17,500 level? Is the minor swing low of 7th of Feb and 6th of February, and also correspond to this upward sloping 20-day moving average that should be coming close to the 17,550 as well very soon because it's moving. So as long as any pullback managed to hold above the key tighten short-term pivotal support for today at 17,500, still maintain that short-term bullish bias on the US Nasdaq 100. Next resistance to watch, Fibo extension level 18,000/18,030, and as well as a cluster area from the last swing low of 1st of Feb, project it to the high of the 2nd of Feb to yesterday low, confluence with one-time Fibo projection as well. All right. However, only an hourly close below 17,500 will negate this bullish tone to kickstart another round of choppy minor corrective decline to retest last Thursday 1st Feb minor swing low area, now acting as a support at 17,120. All right. So net overall, all the major indices are still either at support or coming close to some kind of short-term pivotal support. So we will still maintain that short-term bullish outlook, but however, to a lesser extent on the Hong Kong 33 index. All right. Now, FX market. So FX market, let us start with the major European currency first, euro dollar. So euro dollar going to inch much higher. So I will, and coming very close to our first resistance that we highlighted yesterday. So I'll be using this minor swing low area of 6th of February, 1.0720, so a slightly tightened key short-term pivotal support now. I don't use it so tight, which is 1.0760. That was yesterday minus swing low. So that is more or less will be a pullback near-term support. As long as the pullback near-term support didn't surpass 1.0720, still maintain that short-term bullish outlook or bullish bias on the euro dollar. Above 1.0795, the next resistance to come in to watch will be at 1.0840. That is pretty key. Why? Because it's confluence with a couple of different elements pointing all to the same level at 1.0840. The 200-day moving average, I think as a reason, the downward sloping 20-day moving average, and as well as the minor ascending descending trend line channel low upper limit that I draw from the high of 11th of Jan. Okay, this year. Only an hourly close below 1.720 will invalidate this bullish bias to continue the minor corrective decline to expose the next support level at 1.0665. Sterling dollar. So on the sterling dollar over here, we will still maintain that bullish bias, but right now with a tightened key short-term pivotal support level at the 200-day moving average, because we surpassed the 200-day moving average, or reintegrate back into 200-day moving average. I do not use this level here too tight as my short-term pivotal support level, because it may get whipsaw around this level, which is the 126 figure level. So using a slightly tightened short-term pivotal support at 125.65. So any pullback managed to hold above 125.65, still maintain that short-term bullish bias. First resistance to watch 126.70, which so confluence with the 50-day and the 20-day moving average. Above it exposes the next resistance at 127.60, which is a key medium-term resistance. Why? Because it was tested since 24th of January and refused to break by depleting also since 28th of December, minor descending trendline resistance as well. Only an hourly close below 25.65 will invalidate this bullish outlook to see another round of choppy decline to retest the next support level at 125 figure. So this 125 figure is rather key. Why? Because this is a medium-term support level. Why medium-term support level? Because it confluences with a medium-term trend line, ascending trend line that is in place since 26th of October 2023 swing low. All right. Nikkei 225. All right. So Nikkei 225. This morning it did a bit of a push up. All right. From here, after a retest at the 147.85 level that was tested in the US session two or three times yesterday, but refused to break down. So with that, right, as long as 148.80 short-term pivotal resistance going to hold, we will still maintain that short-term bearish bias on the dollar yen, but it got to have a clear break below 147.85 to give it a bit more of a potential impulse to expose the next support level at 146.75/146.25. Only an hourly close above 148.80 will invalidate this bearish bias to see a potential squeeze up to test the major resistance zone of 150.20/150.20/150.70 level on the dollar yen. Okay, Aussie dollar. So Aussie dollar going to hold above the 65.20 level for today and managed to shape a bounce as well. But it still remains quite this dollar yen, what I'm talking about. Okay, Aussie dollar. Okay, Aussie dollar going to hold above this pullback support of the 65.20 after a reintegration back above it, but I do not want to use 65.20 as my short-term pivotal support level, but it's too tight, just what we saw. So I'll be using 64.90, no change as of yesterday. So as long as 64.90 short-term pivotal support level holds, still maintain that short-term bullish outlook, but the first resistance to watch will be only at 65.70, which is also confluence with the 200-day moving average and the 20-day moving average as well. Only an hourly close below 64.20 will invalidate this short-term bullish bias to see the continuation of this ongoing medium-term bearish a trend that is still in place since the high of 28th of December. Next support level to watch will be at 64.50, which is over here, 64.50, this congestion zone. All right, followed by the 0.618 Fibo extension at 64.10/63.90. If 64.50 is surpassed to the downside. All right, so net overall, dollar strength is still being kept by some form of respective resistance. So we do expect potentially some form of dollar weakness, at least in the short term, to actually creep back into the FX market based on the technical chart that I shared with you. Commodities. Okay, spot gold, no change on spot gold. Still, oh my god, what's my screen? spot gold, no change, still going to trade sideways. So yesterday it managed to go to 2040 before coming down. So I will use yesterday's swing high area as my first resistance. So okay, so yesterday's swing high was 2045. Okay, 2045 level. Okay, 2045. So no change on the short-term pivotal support level, still using 2015 level. I don't put it so tight at 2029, just in case of any whipsaw. So any potential pullback over here managed to hold at 2015, still maintain that bullish bias on spot gold, but it's within a very sideways range configuration. So it's bullish within a sideways range configuration. As long as 2015 holds, first resistance to watch will be yesterday minus swing high at 2045. Above it exposes the next intermediate resistance at 2060, which is much more key. Why? Because this is a medium-term resistance, range resistance that is in place since 5th of Jan this year. Only hourly close below 2015 will see another round of choppy move to test the medium-term pivotal support at the psychological 2000 level. WTI crude. So WTI crude continue to inch much higher. Right now, fast approaching the 74.20 level. So with that, we'll be using a slightly tighter key short-term pivotal support level today. Will be at 72.40. So that was last Thursday minus swing low. I do not want to put it so tight today at this level here. Okay, I do not put it so tight, which is conference with the 50-day moving average. Which is at 72, 73, 25 level, because this is a bit tighter. Okay, so I'll use this more like a pullback support, but as long as the pullback didn't break below 72.40, tighten key short-term pivotal support, potentially the short-term bullish outlook could still remains intact as long as 72.40 short-term pivotal support holds above the 74.20 near-term resistance that is testing right now. Exposes the next intermediate resistance at 75.75. So 75 is this former congestion area over here. You see pretty much clear, and as well as the Fibo retracement of the recent down move, which is correspond close to 61.8%. All right, very close to 61.8%. But however, only hourly close below 72.40 will negate this short-term bullish bias scenario to see another round of choppy corrective downward move to retest the next support level at 70.50/70.20, which is the minor swing low of 8th of Jan and 17th of Jan. All right, so that sum up the short-term technical outlook on the various cross asset. So before we go over here, let's take a look at calendar. What are the key events to look out for today? So for today, right, not much over the European session. So what we have another Fed speak again. So Barkin is speaking again as well at 9:30 p.m. Singapore time. Then followed by a couple of ECB official that is speaking as well. ECB Edison at 10:15 p.m. Singapore time. Then followed by earlier 10 p.m. We have this BOE official speaking, as well as another BOE official that's speaking at 11 p.m. Then 11:30 p.m. You have Euro ECB official speaking, ECB lane at 11:30 p.m. Singapore time. So all in all, right, today's session in terms of economic data will be very, very quiet. Not much data to watch out for in the Eurozone and as well as the US. So US, the one not really that important. This is the weekly initial jobless claim, not as important as the US monthly non-farm payroll data, but something to keep I watch out for at 9:30 p.m. Singapore time. So today will be much more of key central bank official speeches ranging from ECB, US as well as BOE. All right. So with that, thank you for your time and do have a great day ahead, and we shall speak again tomorrow. Thank you.